Welcome back. You're still tuned into Trading Hour. There has been around a 70-point cut from the top on the Nifty, but we are holding with gains of around 25 points right now. So holding in the green, but let's see how we trend from here. Let's also look at the commodity space now. Manisha Gupta joins us, and today she's going to talk about the natural gas prices. Manisha.
Pavitra, thank you much for that. Last week was all about energy prices, especially Friday when we saw 4 to 5% of gains in both the crude varieties, and the natural gas prices gained up by 7% as well. So while the crude prices have gone in for some profit taking, the natural gas prices continue to gain up. We're looking at yet another 8% of a jump up in the international markets yesterday. If you look at the last 1 week, 12% of a gain is what natural gas has put in the US markets, and the Europe and the UK gas prices also gained anywhere between 12 to 18% in the previous week. The strength comes in on the back of expectations that we are headed for colder weather from mid-November onwards. When you look at the global inventories, while they have been rising for last 3 weeks now, but as compared to the 5-year average, they still are on the lower side. Apart from that, when it comes to the US LNG exports, those have been hitting record highs. So when you look at the domestic consumption, while that has been increasing, US perhaps is looking at lower inventories as well. In addition to that, the Maryland LNG exports have resumed yet again. Freeport exports, LNG exports as well, will partially resume by the mid of November. So the markets are taking all of these cues as quite bullish. When you look at the prices itself, we have seen a high of $10 per MMBTU and a low of $3.5 per MMBTU as well. So currently, after the gains that we've seen in the previous week, we are holding almost at a $7 per MMBTU mark. And the markets do believe that until the winter season lasts, this is perhaps a space to be long on. There is expectation of further gains, especially in natural gas.
Okay, thanks a lot for that. Well, that's the word coming in on the commodity space, especially on natural gas prices. But don't lose sight of the market. In fact, a lot of stocks continue to charge ahead. Adani Enterprises at a fresh high this morning, up 130% this year. By far been one of the strongest stocks. So we'll talk about all this and more. We will also be joined by the management of City Union Bank to discuss the bank's second quarter earnings. More on that in a bit. Stay tuned. Welcome back. Banks are definitely the flavor of the moment. So we invited City Union Bank on our show. The lender reported its best return ratios in 19 quarters, aided by the net interest margin improving to a 7-quarter high. Loan growth remains a little weaker though. To discuss the quarter gone by, we are now joined by N. Kamakodi, who's the MD and CEO of City Union Bank. Mr. Kamakodi, thanks a lot for joining in. First I want to talk about the weaker segment, right? Because loan growth is below your own average and below what your peers are doing as well. Can you tell us what is the outlook on loan growth? Why are you not growing at such a fast pace? And what's the average that you could do by the end of the year?
You may remember somewhere around November 2019, even before the COVID, we declared that the things were not conducive for growth, and that's why we were taking our pedals off the growth. Then we had the issues of COVID and all. And even when we were declaring our fourth quarter results, we said things were not pretty okay, and we were not comfortable in looking into the growth aspects. But along with our first quarter results, we said we will be growing between 15 to 18% for the current financial year, and it will be towards the end of the current year. So we still we are sticking with these expectations. We feel we have, after many years, we have now started slowly pushing the pedal, for which we have started changing the internal processes and things like that. So we expect we should be, if everything goes well as they are now expecting, that there won't be any bad impact, further bad impact because of the Ukraine war or oil price or inflation or rate hikes and things like that. On as-is varies condition, we expect we should be closing the current financial year with the 15 to 18% growth rate in advances. And bulk of that will be visible towards the end of the current year, as we have just started pushing the growth pedal.
So what about our net interest margins? Can your net interest margin sustain at the current levels? Because banks have started increasing the deposit rates, so that should start putting pressure on your margins, right? What's the outlook?
Next, almost 3 quarters or so, the numbers should be almost similar to what we have, plus or minus 10 basis point. Normally, whenever you get into the increasing interest rate environment, since your loan book is in floating rate, the rates passed on immediately, and term deposits typically take about 1 year to get repriced. So keeping that logic in mind, the current level of margin should be, holding good for maybe next not less than 3 quarters or so. Almost for the last 3-4 quarters, the incremental, NIM is not more than 10 basis point or so. We are in the same bracket for quite some time now.
So you're saying you expect this to hold as well for the coming few quarters, around 4%?
Yeah, we have been touching the 4% between say 3.9 to 4.1 for the last almost 7-8 quarters now.
Okay, and Mr. Kamakodi, you were saying that you will look to grow at 15 to 18% for the coming year. Can you tell us what segments are likely to drive this growth?
As you might have observed, our core focus is MSME, agriculture, and commercial trading. And when we said we did not want to grow much, bulk of our growth rate came from the agri gold loan. So going forward, the entire growth rate will be coming under these 4 segments. Incrementally, once the regular MSME core advances start growing, the proportion of the gold loan will get plateaued.
Okay. In terms of your slippages, what is the expectation over the next few quarters? What would the run rate be per quarter? And also in your restructured book, can you tell us how much of the restructured book could turn bad? Because some of the sectors that you cater to, right, MSME in the rural areas has not recovered as well as perhaps what one would have expected.
See, we had about, 2 to 2.5% slippage to the closing advances for the financial year 17, financial year 18, and financial year 19 pre-COVID. From the 4th quarter after the arrival of the COVID, for 2-3 years, we had our slippage ratio increasing to about 3 to 3.5%. And things have now started moderating back to 2 to 2.5%, which is the pre-COVID level. More than the slippage, we had issues with the recovery because the courts were not functioning during the COVID period. But now things have started coming back to the normalcy. The gap between the slippage and the gap between the recovery has started almost balancing. The gap is not more than 30-35 crores currently, which is one of the important reasons for our increased, reduction in the credit cost or decrease in the gross and net NPA. And we are sure that the slippage ratio are already, they will be stable around the pre-COVID level. And when I say this, it includes the slippages from the, your restructured book or other core advances or ECL book. All put together, things will be, we have already reached the pre-COVID level, and we are reasonably confident that, this should be stable for years to come.
So this quarter, slippages of 261 odd crore, where did it come from?
It's covered across the sectors almost in proportion to the our exposure in the core book. There is nothing specific to one particular segment or sort of skewed. It's across the segments.
Okay, that is on the slippages. What looks very good for you this time are the return ratios. So the ROA is at 1.72. You have the ROE at almost 16%. Do you think this is something that can hold?
Yeah, we had, consistent track record of, pre-financial year 20 till the 3rd quarter of financial year 19-20. We always had our return on assets above 1.5% plus. On financial year 19-20, we said after the arrival of the COVID, we drew the line at ROA of 1% and reversed everything back to the provision, expecting, if at all anything bad happens because of the COVID. Now everything is, cleared and things have come back to the normalcy. We trust we should be getting back to our pre-COVID level ROA, which we have already gone. In fact, during the middle of the pandemic, when you asked, we said we should be getting back to the pre-COVID level ROA of 1.5% in the second half of financial year 22-23. In fact, that has happened in the first half itself. Ahead of whatever we expected. We hope the current level of ROA should be sustainable going forward.
Okay, on that note, we will let you go. Mr. Kamakodi, thanks a lot for joining in and speaking to CNBC TV18. Thanks for being with us on the channel. That's the word coming in from City Union Bank. Let's see what the way forward is for that bank. But in general, the banking sector has definitely topped the charts. It's not too far from its all-time high of, let's just pull up the bank Nifty for you, about 400 points away from an all-time high. Not City Union Bank, the bank Nifty, that is. SBI, though, after hitting record highs, continues to lose a little bit of ground from the highs of trade. But let's slip into a quick break. On the other side, we'll be joined by the management of Go Fashion to discuss the bank's second quarter earnings and more on the business. Stay tuned.
Welcome back. The corporate which is on our radar right now is Go Fashion, one of the leaders in women's bottom wear brand. The company posted a 48% growth in its revenues, but margins came slightly under pressure, declining by more than about 100 basis points on a year-on-year basis, down to 30.1%. The stock is subdued in today's trade. It's down close to about 0.5%. But if you were one of those lucky investors who got the subscription in this particular issue, remember Go Fashion listed last year at an IPO price of 690. So from that level, the stock is still holding up, practically doubled from last year's levels, the IPO price. But from the listing price of about 1,300 thereabout, the stock hasn't given too much return. We're now joined by Gautam Saraogi, the ED and CEO of Go Fashion, on the show now. Gautam, thank you very much for joining in. Very strong top-line growth, 48%, but the profits are absolutely flat on a year-on-year basis. There is a bit of margin compression. Could you tell us what happened below the revenue line and what's the outlook?
So see, one of the reasons why our margins have declined is because our ad spends have actually increased. Usually we spend about 2 to 2.5% on advertising. This time we spent about 4.5 to 4.8%. We've seen our business coming back to normalcy post-COVID, and this was the best time to do brand building and invest on the brand. So as a strategy, we did some television advertising, we did different mediums of advertising and spent about 4.8% in the first half. So that is why there has been a small decline in the EBITDA margins and the PAT margins. But as far as gross margins are concerned, we've maintained the gross margins what we had last year. So we're continuing to have gross margins of 60%, which will further improve as our EBO contribution increases. So as far as margins are concerned, we're quite optimistic in the next few quarters.
Okay, optimistic for the next few quarters. So what could, I think you have about an 8% or 9% market share currently, if I'm not wrong. Any targets that you have to grow your market share? I mean, this is a very competitive business. Say over the next 1 to 2 years, what would your target be as far as market share is concerned, and how do you look to grow it?
See, over the next 3-4 years, we would ideally want to have a market share more than 25%. See, in such a large market and being a market leader, if you're not able to have 25%, I think it will not do justice to our leadership position. So over the next 3-4 years, our ideal aim would be to have a 25% or higher market share in the organization.
Seasonally, last many years, the H2 has been very strong for all the lending entities. So we see going forward, we'll continue to have a growth of about 25%, as earlier many times you have indicated.
So 24% compounded growth is what you've seen in your AUMs over FY18 to FY22. You're saying that going forward as well on a compounded basis, 25% growth is something that you're targeting?
Yeah, we are targeting a range bound between 22 minimum and maximum 27. This is the range we are following. And we are hopeful to achieve this during the next 5 years as well. This is what we are planning. And in that addition, we added the new product gold loan.
Can you talk on the outlook on gold loans? This quarter, the contribution is 140 crore. But as you said, you just got it started on the gold loan. How fast is it picking up? What's the monthly run rate now looking like? Say in the month of October, what was it? How many gold loan branches will you be opening up? Any guidance in the gold loan?
So gold loan, we are going with the branch expansion. So far, about 130 plus branches are operational. And by March, we are targeting 550 branches. And in next 3 years, we are targeting 1,500 branches. Gold loan business, while it is a secured, it is a very competitive business, and banks are also entering it. So we have to be very, very clear about our customer segment and the kind of AUM growth all the and other than the non-bank lenders are seeing. We want to be among them, and we are clearly see a opportunity to build a portfolio which will contribute towards the profitability. And maybe in 5 years' time, we are aiming about 10,000 crore of AUM, and which hopefully we should be able to achieve it. So we are working towards it. Branch expansion has to be first phase of it. Unless you have branch presence, you cannot have the AUM. So next year, we'll see the sizable AUM building it up. This being the first year and branches are being rolling out. This March, we should be able to close about 800 crore or so.
10,000 crores, you said, for the gold loan segment, right?
For next 5 years.
For
Yes.
next 5 years.
Yeah.
Okay, all right. Are you looking at any other segments? Is auto loans of any interest to you? Because that space is picking up as well.
So auto loan, what we have done is we started the aggregation model where we are a corporate DSA for the car loan for our 6 bank partners. Whereas last month, in September quarter, we originated a fee income about 20 crore plus in that. In the whole year, I think we should do a fee income of 100 crore rupees. And that should be very profitable business because there's no capital employed. We just use our marketing distribution capabilities to bring the leads and pass it on to our bank partners, and where we get a fee income. So this year, the car loan aggregation should give us a good fee income. As I said, gross will be about 100 crore and net contribution about 30 crore rupees.
Okay. Mr. Sharma, you're talking about adding all of these new segments. Can you tell us what is the kind of contribution that you expect from the new businesses? And also, how will the mix change for you? If you can take us through the timeline on that as well.
So if you talk about the contribution, gold loan is it is an investment phase. So I think gold loan in the year 1, which is ending at 2023, we are going to invest in the branches, and the branches become break-even in about 18 months' time. So branch will give us a loss. So this year, this quarter, if we see, the gold loan vertical has given a loss of about 24 crore rupees. Had not this loss be, our profit would have been higher by after giving the tax effect about 20 crore rupees. So profit instead of 56, it could have been 75. But gold loan will start making money after a couple of years. Till then, we have to keep investing in that. And if you say the mix looks like, I think our mix in next 4 to 5 years will be about 40% MSME, about 25% home loan, and about 20% gold loan, about 15% is construction finance. This is the mix we look like at the consolidated level.
Can you talk about the expenses that you will incur for expanding your gold loan branches? I think you said 24 crores in the current quarter. What will the number look like as you scale up to 550 gold loan branches by the end of FY23 and 1,500? And will that put pressure on your margins? Any outlook on margins, sir?
So if you talk about overall margin, gold loan business, we have to continue to invest for next couple of years till this expansions happen. So every branch will come at a break-even and start contributing after 18 months. Till then, we have to invest. So if you open a branch today, it will take 18 months time to start delivering contribution. And we see that gold loan business till FY24 will not contribute. But from 24-25 onwards, it will start contributing towards profit. So yes, the next couple of years, we'll see that this phase still building up will have a negative impact on the profitability. But it will be offset by the profit we are making in the fee income, which is from the car loan. It is income from the increase of AUM from MSME and gold home loan, which is growing at the pace of 35% plus. So overall, I don't think the profit will go down. Overall profit will increase. But yes, this investment in gold loan will start contributing from 24 onwards.
Okay, all right. We will leave it at that. Thanks a lot for joining us, Mr. Sharma, and have a good one. That's Capri Global Capital with their views on the way the book will grow, and they're expanding their presence in the gold loan space as well. They're saying the gold loan AUMs will be 10,000 crores in the next 5 years. But from the entire team at Trading Hour, we will wrap up on that note. It's curtains down. Thanks a lot for watching. Have a great day. A halftime report coming up in a bit.